Hi everybody. Good morning. Thank you for taking your time uh, Friday morning, and thank you for all our participants across the region. I think we've got an interesting session today. I think we're going to talk a little bit about our views in terms of how a Trump and a Republican clean sweep reflects in terms of the markets. We also had the Fed cutting rates further, and today we've got some meetings in China who will also kind of drive the markets. But I think fundamentally we think that there are some material discussions that we need to talk about. What are our views? How would that reflect the markets going forward? Of course, we continue to believe the markets continue to be dynamic, but this kind of provides a certain pathway, certain views that we have, and I think we're going to talk about the implications of this this into your products, into your investment solutions, and into your investment calls. So today I've got two colleagues from the multi-asset team today. I've got Dharmo, who sits with our investment partnership and solutions. He also is the chief investment strategy for UOBAM Invest. I've got Wayne, and he's part of the multi-asset research and strategy team. Dharmo will spend a couple of minutes talking about our overall view. Wayne will then cover it point by point in further detail, and then at the end of it, we will basically do a Q&A. So if you've got Q&As and questions that you want to ask, please feel to put it into the text box, and we will then address it at the end of the conversation today. Okay, so I'll pass it on to Dharmo. Dharmo will talk a little bit about our overall views, and then Dharmo will pass it on to Wayne, who will speak a little bit about specific points that we look in this current situation. Dharmo?
Okay, thanks, Shankar. Thanks everyone for joining this call. We had obviously the Trump election to be the U.S. presidential elect. Sorry, Trump's election to be U.S. president, the next U.S. president 2 days ago. And we'd like to talk a bit about what that means, what are his key policies and what he is likely to implement, and what will it mean for economy and market, right? So basically, I think if we look at sort of the summary, the Republicans have won the presidency, the Senate. At this moment, the House is still not concluded yet, but at the current rate that it's going, it is likely to go to the Republicans as well. So this is probably one of the few Republican clean sweeps that we get, which basically give Trump and the Republican Party a lot of power in terms of making changes. Okay, so basically we think that roughly speaking, Trump's policy should be stronger for growth, but it is also likely to be likely to cause higher inflation. And I think there would be larger budget deficit, which would probably be have implication on interest rates and the fixed income market going ahead. But I think that's sort of the fairly consensus view. And we think that generally speaking, it should be positive for equities. And in equities, we think that it'll be good. It'll be better for US equities compared to ex-US. So that's probably what we can expect. And I think on Asia, I think given his concern, given his rhetoric on having tariffs on all imports, especially those from China, I think there is probably a bit of uncertainty and volatility with regards to Asian equities, especially China. But obviously, there is a mitigating factor coming from sort of the stimulus package that we expect from the Chinese government. What we've seen, market has reacted. U.S. market was up almost 3% on the first day, and then up another percent yesterday. So basically, market has started to price that in, and market has also started to price in. Bond market has actually also started to price in the risk of higher inflation and sort of bigger deficit in the sense that we are seeing sort of bond yield creeping higher in the last couple of days, and the dollar obviously has strengthened along with that. So we think that that's basically the big picture. We think that there's probably the concern of reduced check and balances on Trump, On the geopolitical side, we think that there is tariff risk, but the question is partially also about what happens in the Middle East and in Russia and Ukraine. I think those are interesting points that we can explore. And I think in compared to the status quo, we think that what we would see is higher growth and sort of higher inflation going for the next 4 years. Okay, so with that, let me hand it over to Wayne, who will cover the all this in greater details. Wayne?
Yep. Thanks, Dharmo. So, Dharmo sort of gave the overarching big picture views that we have. So let me just share with some of the supporting slides. So this is a slide that we have used quite a bit, I think, heading up into elections. Clients have been asking us what our views on election, what basically are the impacts on the economy under different administration. So it's still a slide that remains very relevant until today. And I would say the 4 key major areas of changes we can expect under a Trump administration will be that of trade, fiscal policy, immigration, and industrial policy. So I'm just going to run through them briefly, given that a lot of these are, like what Dharmo say, are Trump's rhetoric. He's likely to be doing a lot of posturing. These are not his final policies, but nevertheless, it's useful to know directionally what he's looking to do. So the first on trade, I think it's no surprise to know that Trump's weapon of choice when it comes to dealing with trade is that of tariffs. So in terms of his stated tariffs, he has long talked about wanting to implement 60% blanket tariffs on all China products and another 10% on all other imports from the rest of the world. So that itself should drive up US prices and it's inflationary incrementally. Second, on fiscal policy, Trump is a very pro-business guy. He likes tax cuts. In 2017, he was the one that launched sweeping measures on tax cuts, brought down corporate tax rates from 35 to 21%. And with this expiry of tax cuts in 2026, it's likely that Trump would want to continue to extend the tax cuts in 2026. And that itself should boost growth and should also be a lot more beneficial for smaller companies which are running a higher tax bills relative to their revenue. The third thing is on immigration. Immigration growth has actually been pretty solid over the past few years. That has itself that's increased the labor supply of the US economy, has allowed for stronger growth in the US economy. And I think on this issue, I think Trump is very much against immigration. He has talked about deporting all the 20 million or so immigrants in the economy. And while we think, again, there's a bit of posturing, it won't be a surprise if we see immigration growth at least starting to come down from here. I think the fourth is that of industrial policies. He has had a lot of corporate policies. He talks about a lot of deregulation in the financial sector. He's not a big fan of clean energy policies, which is a big pillar under the Biden era. And hence, you can expect a lot more pro-business industrialization, manufacturing type or infrastructure bills to be passed under Trump. And in terms of macro implications, again, we've covered quite a bit. It tends to be good for growth, better business sentiment, tax cuts, good, again, very good for growth. Inflation should also be higher. I think Trump's policies of tariffs, anti-immigration policies, which reduces labor supply, they should all lead to higher inflation in the US. And of course, budget deficit, which Dharmo has talked about. I think that was our views going to election, and I think unsurprisingly, that's also pretty much the views of most people within the industry. So this chart here is surveyed on fund managers on what they would think, how they think the economy and markets would react under a Trump presidency as well as a clean sweep of the Republicans. And unsurprisingly, they see fiscal deficit higher, inflation higher, bond yields higher. They also see it to be positive for the equity market given better growth. Again, I think where it's a bit mixed is their view on growth and the dollar. But even then, I think more of them do think that growth should likely be stronger and the dollar should be stronger under a Trump era. So how then are we also sort of different here? I think a lot of economists will point to you to Trump's policy. They say tax cuts are good for growth, and that's no doubt true. But I think one other factor that is less talked about within the markets is that of the business confidence, or what in UOB we like to term it as the animal spirits within the economy. And this chart here sort of encapsulates that idea that generally business confidence or consumer confidence under a Republican or under Trump tends to be higher, and that itself do drive business decisions. So if you look at this black line here, that's what we call the Michigan of Consumer Sentiment Survey Index. That is usually an indication of how consumers are feeling in terms of their prospects and in terms of their current spending and outlook. These things are typically also very much affected by things like inflation as well as the economic recession outlook. And if you can look across the various terms, during Trump's past term, the consumer sentiment survey was actually pretty high. Compare that to the recent consumer sentiment survey, where we have seen quite a big dip within the sentiment survey. We've seen that under Biden, consumer sentiment has actually been pretty weak. And that itself is also partly due to the bias of how people vote. So in this survey, they do split it up to how the Democrats vote as well as how the Republicans vote. And unsurprisingly, the Democrats think that the economy is worse under Trump. Republicans think that it's better, but the Democrats think that the economy is better under Biden, but Republicans think that it's worse. Where it's sort of jarring is that if you look at this consumer sentiment of the Republicans, it is really low at this, call it within 40 to 50-ish range. And that itself is lower than what we saw during the global financial crisis, where I think consumers were actually more optimistic about the economy back then as compared to now. So there's a bit of political bias going on, and we think that this survey does capture that. A lot of these small businesses tend to be very pro-businesses and hence very much a Republican in nature. And I think there's this sense that there could be a return or a resurgence in consumer confidence under Trump during the next term. And hence that itself is good for growth, given that more and more businesses are likely to spend more and to do more capex. So that we think is an important factor going into the next term for Trump. So the good thing about trying to understand this move and why so many of the views of growth and inflation is pretty much consensus is because we have had a very case study through Trump's first term. And I think you can just see from this chart when he took over in 2017 all the way to 2020, growth actually turned up quite a bit stronger. So if you look at this pink line here, which is the nominal GDP growth referring to the right-hand side, you can see that picked up quite a lot from the lows of 2016 and even 2015, ever since Trump took over and came up with his infrastructure bills, his tax bills. And subsequently, as a result, markets also did well. So this blue line here is that of the S&P 500 earnings growth, and that picked up as well with nominal GDP growth trending up. Of course, I think the key thing about Trump is that he's a very binary person. We don't really know which side you will see, and the one big problem with that is that of tariff risk. So we talk about the 60% tariffs on China, 10% on the rest of the world. And in this case, we have tried to compile some of the modeling that's done by quite a bit of brokers out there. And I think all of them sort of land into the same area. Generally, with higher tariffs, economies spend less because price of goods gets higher, and GDP growth should be lowered roughly by 1%. I think this is an IMF estimate. In terms of inflation, you tend to see a spike up in inflation pretty fast, given that the cost of goods rise quite a bit, but it sort of stay from there on a delta perspective. Bond yields should be a lot higher under tariffs, and dollar should be stronger given the whole risk-off sentiment, and given that a lot of this growth is now concentrated domestically in the US. And of course, the natural impact is that Asia economic growth takes a hit. Exports, which is key to Asia, takes a hit, and hence Asian equities in the medium term, if at greater risk, if Trump does launch his tariffs as he has shared. The other thing to note is that just using historical precedents, it's actually it should be noted that Trump can actually enact his tariffs really fast. So from announcement to effective date, that can be as little as 1 month or even less than that. And so basically, given that he's likely to have a clean sweep of Republicans are likely to have a clean sweep of the Congress, Trump can easily enact all these tariffs, and that is something. These are key binary risks that we have to be watchful of, but that this is also sort of the reality of what should happen over the next 4 months and next 4 years. So speaking about tariffs, I think these are just some of the impact of tariffs. Inflation crept up quite a lot. So a lot of these tariffs were launched in 2018, and the impact can be seen in core inflation quite fast. So since, as you can see, core inflation, which is the pink line here for the US, picked up quite a bit. It only started to decline in 2019. That was due to the corresponding effect of lower GDP growth, and hence with things like tariffs, it's very hard to forecast. People model it out, but just using this historical example, you actually get a spike in inflation, and inflation coming down just because the hits on growth outweigh the hits on the increase in the prices of goods sold. So those are our views on all the macro type impacts. When it comes to the implications on the way we invest, we sort of branch out these investment implications to the various asset classes which we think will see the biggest impact. So under a Trump win, and we sort of prepared this chart just 2 days before the election, and hence we still hold these views. Under Trump win, I think as Dharmo has shared, equities should be very much buoyed by this whole animal spirits. You have the uncertainty of an election stalemate going off, and hence equities should in the near term be very much supported, and we should continue to see a risk-on rally. Generally, just before this election, we already had a positive fundamental view on the economy, and hence I think our stance have always been to be overweight equities. And under a Trump election, under a Trump's victory, we don't see why we should be any different, and we continue to remain overweight equities. Within Asia equities, we have been positive on Asia equities, I think sometime mid this year. Part of it is because valuation is so low, because investors are staying on the sideline. And I think that was also very much supported when we saw more and more China stimulus measures coming up. That being said, in the near term, we do think that some of the stimulus effects could come through. Where we are a bit concerned is really that of tariff risk. And I think we are inclined to at least reduce some Asia equity exposure, at least in the medium term. But we don't see a big problem, at least over the next 1 to 2 months. For bonds, the direction is clear for bonds. I think most of Trump's policies are incrementally positive for growth and very much a danger for higher inflation. The starting point of today, where we have higher inflation, makes it a bigger problem, and hence we do think that bond use in the medium term should continue to go up, and hence just on fixed income, we would advise to be a bit more defensive and stay in shorter end bonds. Lastly, on the dollar, because of our views on yields, because of how growth is likely going to shift from rest of the world to be even more concentrated in the US, we do think that the dollar should continue to display strength over the next 1 to 2 years. And hence, in the medium term, we would advise to have a bit more exposure on the US dollar. So just some charts supporting those investment implications. This is the chart on S&P 500 around close presidential elections. So I think there were about 6 close presidential elections where if you look at polls were very close, and those elections tend to have a lot of uncertainty within the market, and we tend to see a drawdown of the markets before a rally of the markets. We did see that the drawdown for this year was a bit less, about 2%, I think just 2 days before election. But right now what we are seeing is this whole very strong post-election rally, given there's no uncertainty of stalemate, and given that Trump, who's very much pro-growth, has won the election. And hence, I think the message here is clear that in the near term, equities should continue to be supported. Generally, equities do very well post and the presidential election, and with the exception of 2008, where we was back then during the global financial crisis. So you can see in 2022, S&P 500 rallied by 6.5% over the next 3 months. In 2016, about 8% over the next 3 months. And in 2020, about 14% over the next 3 months. For the 6 months and 12 months, it's even stronger. Though I think the other point we would like to highlight here is that not just the broad markets, not just S&P 500, but the broader markets where like even markets like the small caps could even benefit greater under a Trump's victory. So that is generally the case even across all presidential election. And if you look under the Trump's election, the outperformance is also pretty stark, where the small caps returned 14% over the next 3 months compared to S&P 500, which returned about 7.8%. And the reason for that is pretty clear, where I think tax is a big problem for small companies, where small companies have less resources to manage their tax bills, and hence their effective tax rates tends to be higher. With Trump and one of the key pillars of his economic policies being that of tax cuts, that itself helps small caps even more. I think today we also got the FOMC cuts. Cost of debt is a bigger issue for small caps, and hence all these factors do continue to support the fact that small caps could outperform over the next few months compared to that of the S&P 500. Regardless, the bottom line is we should stay invested in equities. I think the next few months should be a pretty good months for investments. I think some of our clients have also asked in terms of our sector preferences post-election. I think this part here again is quite consensus. So Trump is very much a pro-business guy. He's all for deregulation. If you think about the macro impact, stronger growth, stronger inflation, higher use, all those. The policies that he's likely to pursue plus the macro impacts tend to favor the financial and energy sector. So within financials, he has talked about deregulating them less, whereas Biden, a bit more socialist in nature, has often been harder in terms of regulating the banks. Higher use also support banks. And if you look at the past sector returns during after the election as well, financials have done really well, energy has done really well as well. Though of course, I think post that 2017 there was a bit of lull and energy sector did give back. But nevertheless, I think if there were any sector to really pound the table on, financial sector looks pretty good. Looks like a pretty good bet. So that was for equities. If we think about it for bonds, budget deficit, the US is already running a lot. The US has fiscal deficit of 6% GDP, and that looks likely to expand under Trump. That has implications on bond yields. So if you just look at historical bond yield movements, I think following the election, back then bond yields rose quite a bit by about 100 basis points following the election. There was again a bit of lull there where bond markets stabilized. I think markets was having a wait and see approach to the type of policies that Trump would launch. But after the announcements of all the tariffs, which I mentioned was in 2018, the bond yields actually rose quite a bit. And all in all, I think this yield movement was roughly about 100 to 150 basis points during Trump's term. Given, like I said, given today's starting point where inflation is already a problem, growth is really running pretty hot. Bond yields could be a big rising bond yields could be a big risk for even the equity markets. As of now, is given that bond yields have been driven by higher prospects of growth, that's less of an issue. But as and when inflation expectations become higher, we think that is a big risk for both bonds as well as equities. And on Asian equities, I think one of the key factors that always drive Asian equities is that of the dollar strength. So when the dollar is weak, Asian equities tend to outperform, and when the dollar is strong, Asian equities underperform. In this case, you can see that if Trump does launch all his tariffs, the dollar should strengthen quite a bit. You can see in this DXY, this blue line here, and also all the Asian currencies. In this case, we use the USD CNY. CNY should depreciate quite a bit against the dollar. This is a period that would generally be very bad for global investors investing in Asian equities, since we tend to invest in them on a dollar basis. So even using this historical experience, we can see that a lot of these Asian currencies also suffered quite a big depreciation during this whole tariff trade war of 2018 under Trump. And in terms of the impact for Asian equities, Trump launched his tariffs in 2018. Today, he can very well do it within the first month or the first 6 months of his campaign. And when that happened, you could see the Asia equities actually underperformed quite a lot. The underperformance was as big as 15%. And on an absolute basis, I think Asia equities was down 20% for the year, or for that period. We don't think that this underperformance will be as stark today. China's export is less reliant on the US, but nevertheless, having tariffs is a negative sum game. China is likely to be impacted. ASEAN will be somewhat impacted too. There's some mitigating factors, but I think as a bloc, export growth should decline, and hence we do see some underperformance. And that itself is also reflected in earnings, which are what we as strategists ultimately track. So if you look in terms of the annual earnings growth of the global equities versus that of Asia equities, which is the pink bar here, you can see that following all these tariffs launch, earnings growth actually declined quite a lot in 2019, and that decline was a lot more stuck in Asia compared to the global equities. And hence, in the medium term, we would be wary of being too positive on Asia equities. So that's really what I have to share. I know I shared a lot. Just to quickly round up, macro impact, we think stronger growth because better animal spirits, more pro-growth policies. However, they are also very inflationary by nature. We should also see a larger budget deficits under the proposed policies of Trump. Our investment views is to continue to stay invested in equities. Within Asia equities, we should be a lot more cautious in the medium term. In the near term, we do see some counteracting effects from Chinese stimulus being positive for Asian equities. Bond news is where we would advise investors out here to be a lot more cautious. We think that there are two ways bond yields could go up. The first is that rate cut expectations could be reduced in 2025. As you know, right now the Fed is under a rate cutting cycle, and that rate cutting cycle could be paused if inflation starts to come back strongly. We think that bond yields in the longer end could also see a bit more steepening if there's greater uncertainty over inflation, despite having stronger growth. I think net we advise that being invested in the dollar would be good and a good diversifier for portfolios. So I know a lot of investment presentations tend to also talk about key risks, but in this case, I think over the next 4 years, we think it's more important to be a very good risk manager compared to that of investment manager. And why I say that is really because Trump himself and all his policies are very binary in nature. We don't know which side of Trump is going to show up. I think the post-election speech, Trump was very much pro-growth. He talked a lot about tax cuts. He didn't really mention anything on tariffs. So that's the good side of him, and maybe that's why markets rallied to the extent that it did on post the election victory. But in any case, Trump is likely to bring about a lot more volatility in markets and the economy over the next 4 years. Trump has already shared that he's only looking to hire yes men this time into his cabinet. There'll be a lot more reduced checks and balance on Trump. We do see geopolitical tensions escalating more, especially with the issue in the Middle East, and I think Dharmo has talked quite a bit about that. The other thing is that compared to his first term, we are in a different starting point when it comes to inflation and growth. Again, back then the issue was that the economy was underheated. We couldn't hit the inflation target of 2%. Today we are already somewhat a bit more overheated, and hence any of his policies is likely to sway markets even more. And hence, again, we think because of all this, it's just important to just be on our feet and just to stay a lot more cautious in the next 4 years, given this whole greater volatility. That said, we think it's mostly still positive. Growth is positive, and hence we will continue to advocate a message that we should stay invested, but also be more cautious. Yep. So I'll just stop here for now, and maybe we can just kickstart the Q&A.
And thanks, Wayne. I think that's quite a comprehensive view. We've highlighted a couple of key points, but maybe just while Wayne has already done a good summary, I think it is a positive thing to the markets, especially the equity markets, especially US, and we've already seen that moving. I think while a lot of it has already been telegraphed and we do have precedents, I think what we're trying to also say here is that the context is very, very important. The context of the previous election, sorry, the previous Trump administration and the current Trump administration, the markets are very, very different. A lot of the policies that he talked about, which were maybe perhaps a bit more shocking to the markets in the first term. Now in these terms, a lot of the markets have already been it's already been translated to our markets. We know what's going to happen, and I think in that sense helps a little bit with the volatility. Okay. Let me start to remind the participants of the two things. First, if you have any questions, please feel free to include it in the Q&A box. Second, we've also published a write-up on this. You can access it from our website. Please feel free to also sign up for our newsletter so that you can continue to get this kind of updates. Okay. Let me just move into the Q&A session. And I think we've touched about this a little bit in the conversation, but I think given that we do have a lot of participants within the Singapore and the ASEAN markets, maybe can we talk about it a little bit more? And I think when we talk about us being a bit more conservative in Asia, and where tariffs comes in, I would presume that's a lot more North Asia, particularly in China. Maybe can you elaborate a little bit in terms of how this impacts two parts, right? The equity markets in this region, as well as the yield implications, because ultimately in the last cycle, we saw a lot of rates. It also was beneficial to a lot of clients because the dollar provided a good backdrop in terms of getting clients good and attractive rates. And maybe we can start with that. Yeah.
Okay, if I may start with that. I think the implication on the US markets is probably the clearest. The implication on the Asian markets, I think there is probably a lot more nuances, right? And depending on how this plays out, I think if tariff is imposed on China, I think that's and also on other countries, then there probably will be negative impact on North Asia. And for the rest of Asia, I mean, Southeast Asia, ASEAN, we are fairly dependent on China. But obviously, there are mitigating factors. I mean, if what happens is that what we get is that people actually end up being friendshoring, meaning that instead of manufacturing in China, they move their manufacturing to places like Vietnam, even Malaysia. You actually see benefits to these countries. And we already started to see that in the sense that Malaysia is seeing a lot of FDIs coming in from the electronic sectors in terms of data centers. You're seeing those sort of benefits in terms of people trying to de-risk their China exposure with a sort of China plus one type of strategy. So I think for the rest of Asia, there is probably a bit of nuances there. I think obviously what people who might get affected will be things like if China growth slows down and China consumption slows down, then you probably see fewer China tourists, and the biggest impact would be places like Thailand. So I think it is nuanced. Each country probably feels that impact differently. And I think that's probably on the real economy. On the equity market side, I think a lot of ASEAN or a lot of Asian markets tends to be Singapore especially is fairly open. So we are very closely related to the US. And as long as the global economy is growing and US being a big part of it, we tend to do relatively well. The other countries would really be dependent on the net effect on the economies, really. So I think that's probably where we see in terms of there are differences in the performance of each individual market. On the rate side, on the bond side, I think today we see the risk is really not on growth. We think that there's a lot of hidden growth that's going to come back, whether in the form of in the US, there were pullbacks in terms of capex spending because of the uncertainty of the election. But once that clears, people start investing again, people start hiring again, and that is actually going to provide another boost for growth. And then if you have sort of, if Trump gets his way in and he tries to reindustrialize US, meaning that getting people to build manufacturing plants in the US, then again, that is probably going to drive further growth. So the challenge today we have is not really about growth, it's about inflation. It's about the fear that all this, we are already in a situation that the economy is pretty robust, and you are adding fuel to the fire in a fairly robust economy. And I think that's where our concern is, right? So we think, if anything, that there would be fewer rate cuts, because at this moment we don't think that there'll be rate hikes, but at this the fear or the concern will be where we think market might get it wrong is that there might be fewer rate cuts going into 2025, right? And especially if inflation starts to pick up, Fed might actually hold back on its rate cuts. So I think that is one key area in which that we see the risk of market getting it wrong. And then if that happens, then what we are going to get is a strong dollar kind of environment, as Wayne mentioned. And then obviously the US rates tend to dictate sort of a lot of rates around the world, a lot of monetary policy around the world. And I think that probably, that sort of mood probably gets filtered down to Asia as well, and we might see a higher rate environment going forward than what we really expect today.
Thanks, Dharmo. So heading on that, we alluded a little bit about one of the major changes here is the implications on inflation, and we talked about how our views have changed slightly from being a little bit more where we're looking at the whole curve, and now we actually focus a little bit more on the terms of the short end. Maybe for the benefit of the people on the call, maybe can we talk about what do we mean by the short end? How long durations are we looking at? And second, what are the benefits of this, especially given that, okay, while there is growth and we're talking about managing risk, I mean, Wayne talked about that. How does that play a role in terms of a multi-asset portfolio and why we really like that area at this point in time? Yeah.
Okay. So if we expect a lot of rate cuts, then basically we should be on the long end of the curve, which means that somewhere nearer the 10-year end of the curve, which probably benefits when rates when there are rate cuts, right? But if we expect less rate cut, then what we would see, rate cuts typically affect the shorter end of the curve more, meaning that somewhere around the 2 years, 1 to 2 years type of end of the yield curve. If we expect less rate cuts, then what we are going to see, I mean, imagine today the futures market is pricing about 4 more cuts or 1% lower rates by the end of next year. That's basically what the Fed Fund Futures is saying. And if that's true, yesterday, excluding yesterday's cut, we used to be at 5%, which means that by end of next year, they were expecting about 4% in Fed Fund rate. And whereas the 2-year curve, 2-year is actually about 4.2, call it 4.25, right? So basically, if you think of it, the spot rate and the 2-year rate is actually relatively flat. If rate cut is going to come much slower, and assuming that inflation is hotter and instead of having 4 cuts instead of 4%, they only do 50 basis points cut by end of next year, then the Fed fund at the end of 2025 will be 4.5%, which means that the 2-year curve, 2 years yield is probably too low, which means that the 2-year yield will have to go up in order to adjust to that expectation, right? And when that happens, the good thing, obviously, if you have a short duration, it has less impact on your capital market, but at the same time, you are getting higher yield sitting on the 2-year rather than sitting on the 10-year. I think that's probably the implication of having staying closer to the short end of the curve. So I think if we are right, meaning that if inflation really do come down slower than expected, or if anything picks up, then our advice, our position would be that we have to shift our bond portfolio towards the short end of the curve. 1, for higher yield pickup, and 2, obviously, for lower capital loss if rates do go up.
Yep. Just to add, just to see the differential between the 2 years and 10 years. So the 2 years is at currently the US 2-year Treasury is about 4.2 and 10 years is about 4.3. So again, a relatively flat market. So given that potential capital appreciation is less in the longer term, the preference is obviously to go to the short term, take that nice carry, and help to provide some diversification of the assets. Dharmo, there's another question, and maybe you can add this on. So the question is on private equity in 2025, but maybe let me expand this a little bit more. In the last maybe 10 years, we've got a lot of conversations on alternatives. So that alternatives includes the conversations on private equity, conversations on private debt. And in this case, I think I want to talk a little bit about commodities as well. How does this change in terms of these asset classes, given that they are generally driven by rates? Private equity a lot more driven by low rates, and private debt, obviously, people looking for alternative sources of funding. Yeah, maybe Dharmo, we can help. Dharmo, maybe we can help with this.
Yeah. I think the private market has been driven by the search or the desire for lower volatility kind of investments, especially given how market has been volatile in 2022. And even we see bouts of volatility in the last couple of years, right? You see huge market correction, you see big swings in bond yields. So I think that has sort of driven the desire for a more lower volatility types of investments. And private markets seems to offer that, partially obviously because they don't mark the market on a daily basis, right? But private equity, let me take one by one. Private equity especially is really actually cannot be disjointed from the public market. So if public market doesn't do well, private equity technically wouldn't do well as well, because you need a healthy public market in order to exit, in order for all the private equities to go for IPOs. And also, even if you talk about trade sales, if the public market is cheap, then you can't sell for a good price, right? So private equity cannot be dislocated from the public market. It's just that because they don't mark the market every day, so it always looks better. They don't need to mark down their position or their holdings. So what we think is that if we see a sort of a buoyant equity market in the next couple of years, I mean, especially in the US, then private equity actually can be quite interesting, right? Private equity would be able to sort of exit at better valuation, and you would also see a more active IPO market. So that's probably what would be positive for private equities. But bear in mind that these would be private equity funds whose vintage is probably people who have invested 5 years ago or 7 years ago, that can exit today. I think the challenge obviously is that if equity market is buoyant and equity valuation goes high, then if you are a new investor in a new private equity, I think the challenge is now you are fighting for deals, meaning um, if companies can go public easier, then they don't need private equity, and it's more difficult for you to find deals at good valuation. So I think that is where we think that the private equity uh, outlook would look like in the next couple of years. So those who have invested 5 years ago probably would do pretty nicely. Those who are looking to invest today, I think the uncertainty is really what happens 5 years down the road, especially if inflation picks up and that affects interest rates and affects market, right? So I think that's the view on private equity. And I think on commodities, I think there are two parts of that commodity story again. One part of it is obviously uh, Trump is talking about scaling back on renewables and sort of uh, putting more emphasis on fossil fuels, on the energy, on sort of traditional energy. In that instance, it tends to be negative for commodities because bear in mind that a big chunk of the commodity stories was, if we are going to decarbonize, we're going to go renewables, we need a lot more copper, we need a lot more of all those commodities in order to decarbonize. So that sort of gets played down a little less. But what gets played up, obviously, is that if you have a lot more capex spending, and whether you call it nearshoring, friendshoring, people shortening their supply chain and rebuilding factories nearer to their home markets, that capex spending is probably going to be positive for commodities because what you're going to get is you need a lot more iron ore, you need a lot more cement, you need a lot more copper, right? So those would probably be positive. I think so. If you look at it, there are sort of both positive and negative. I think net is probably mildly positive in the sense that US sort of scaling back renewable probably is the sort of a slight detraction or distraction from the trend that this whole uh, progress towards more renewable is going to continue, right? So I think that's probably the commodity story. I think it's you get different noises or different voices. By the end of it, it's probably going to be mildly positive. Um, on the private debt side, I think that would probably be slightly negative. And I say that because what I think in the last couple of years, what we've seen is a sort of tighter regulation on banks have sort of driven the sort of private credit market because banks are more tighter regulated. They start withdrawing. I mean, the need of capital was higher, and so they start withdrawing from certain part of the lending market, which sort of generated the sort of which left the vacuum for private credit to come into the picture. But if Trump really does scale back regulation on banks, then I think what we are going to see is that basically banks are likely to come back into some of the lending spaces. And I think that probably means less opportunity for private credit. And so private credit, bear in mind that private credit raised a lot of money this couple of years, especially last year and this year. So what might happen is that they may end up chasing deals that are of a lower quality, which probably would have implication in terms of default rates going forward. So I think private credit would probably be a slightly negative kind of scenario going forward.
So Damo, I think on that context, maybe I want to ask about one very specific commodity. Given a higher inflationary environment, you've already seen new highs on this. What about gold? And gold in the context of alternatives provide a little bit more of a different point of view. It's a little bit more in terms of hedging. It's a little bit more in terms of inflationary. What's our views in terms of gold? Two parts, I know. Trajectory one, and second, in terms of a role of a portfolio. Yeah.
Okay. We like gold. I think there are a lot of roles that gold play. One, obviously, as you mentioned, is as inflation hedge. Second, as a hedge against geopolitical risk. I think that part is really important in the sense that if we are getting into a world that is more and more hostile, and people worry about the US, people worry about their reserves. I think central banks that are not too friendly with the US would probably try to hold less US Treasury and hold a bit more other assets. And if you look around, many of the sort of other assets are really quite limited, and gold is probably one of the few options available for them. So we think that on a net basis, that's probably the structural trend that is supporting gold. In the short term, there could be a bit of volatility, like what we see, when risk comes down, gold prices usually softens a bit because there's less need to hedge. If rates go up, interest rates goes up, gold prices tends to face headwinds because the opportunity cost of holding gold, which doesn't that doesn't generate income, is now higher, right? So the third point could actually be if China succeeds in reflating itself or reflating the market, there might be also a bit of headwind for gold because we realize that part of the gold story in the last 1 year is Chinese buying gold because they couldn't invest in the property market, and then the stock market hasn't done very well for them. So they'll basically be buying gold as a form of store of value and store of investment. And so if the Chinese market really recovers strongly, we may see a bit of headwind for gold. But I think the structural story remains intact. We think that gold is probably the asset class that many central banks wants to own more. So I think we are definitely positive gold, and we think that it's a great diversifier for one's portfolio in the long term.
If I may also add, just on this point, I think it would be wise to not underestimate, I think, what Dharmo has said, all this structural story on gold. I think back in 2018 or 2019, post this whole recent increases in tariffs, which we saw that Trump did, I think a lot of central banks started to turn to gold more as a safe asset, as an asset for their for their reserves. And gold actually rallied a lot. I think that period, I think just 2019 alone, it was up 25%. Post the Russia war, we see Russia continue to add more gold to their reserves as well. And if we are right that geopolitical tensions escalate from here, I think the role that gold plays for central bank assets just become even bigger. And not to mention that if we do see a recession, because just gold is just a very, very solid diversifier out there.
Thanks, Wayne. Thanks, Dharmo. So let me end in a relatively positive note. So yesterday we saw new highs with the US stock markets, new highs for your Max 7. That's very exciting. Maybe the last question, and mindful of time is here, so follows. Do you see that broadening up? I know we are over it a little bit more in terms of the US markets and as a proxy to that, the global markets. Do you see, given what Trump is proposing, given the tariffs that he has, we talked about small caps a little bit, and maybe specific to the way forward, do we see these opportunities broadening out, especially in the global and the US markets, as opposed to just the Max 7s? Yeah.
Sure. I think it will, definitely, because as we've mentioned, I think what we've seen is obviously the deregulation story is kicking in. People are starting to buy US banks. I think that looks attractive. I mean, banks are cheap, banks are trading at cheap valuation. So I think there is that attraction of broadening up to the finance industry. And obviously, small caps that benefit from tax cuts that we mentioned, and obviously also from deregulations because compliance cost goes down and that benefits small caps more. We think that, for example, industrial sector would do well if there's a lot more spending on capex. That probably usually benefits the industry sector. And I'll throw in probably a more less consensus view is defense stocks probably do well, given that with this sort of US probably less involved in sort of the conflict in other parts of the world. We expect that defense spending in Europe and maybe in other parts of the world would probably go up. I know it's morbid, but it's as an investment, we think that that's probably another area that could really benefit from that. So it will broaden out, and I think that's probably we think it's not going to be just about the Max 7. It's probably a lot of all other sectors that benefits from this. Wayne, you have any thoughts?
I think that's all well said. If anything, just from a macro implication perspective, a lot of this growth would likely be shifted to US domestic growth. Max 7, they do benefit from a bigger global growth perspective, but all your US manufacturers, your industrial players, I think with this whole uncertainty of election over beyond them, we do think that there should be a pickup in all these sectors and hence broadening of the whole stock market strength in the US.
Okay, thanks Dharmo, thanks Wayne, thanks everybody for being with us today. I think what we want to say is this: there are a lot of opportunities out there. We do see some rising risks in certain areas. We're seeing some rising opportunities. But I think overall what we want to say is this: there are a lot of investment opportunities. The need for diversification in this kind of market is key. There is some context in terms of how Trump is going to take on his new presidency with history, but we have to take this in the context of how the markets are moving today. We thank you for your time. We remind you on a few things. First and foremost, our updates and our website are available. You can see, you can read our views from there. We've covered quite a few pointers in that. Sign up for it and you get our updates going forward. So in the meantime, I just want to wish you guys a happy weekend. Thanks for joining us this Friday. All the best, and we hope to see you soon in other conversations. Thank you very much, everybody. Bye-bye.
Thanks, everyone.
Thank you.